Hi everybody, this is Jack Carter and I want to give you a quick weekly options profits case study video. Of all the ways to make money with options, odds are you'll have the most success with the strategy we'll cover in this case study. The odds of success are dramatically in your favor because this strategy takes advantage of time decay, which is what kills options. You know that most options expire worthless, we already covered that, and here's how to take advantage of that fact. You sell options while they have a little time value left and then simply let them expire worthless. And again, we don't just use any options, we only use weekly options, and the reason is because weekly options expire every week. So this case study is about the number one way to make weekly income with weekly options. And the basis for this case study is a trade we alerted a small group of traders to. Every week we try to find trades that will produce weekly income with low risk. And this is the trade alert we sent out to our VIP members. So we tell you the exact stock and the strike prices to use and how to do it, but you can modify this any way you want to get the type of yield you want. So just to look at this trade in review, the pick was on Google, and we were using a bull put spread. The stock was at 745 per share, and we like the spread of selling the 717.50 put and buying the 712.50 put. And then we give you the option to do that, and we give you a expectation of what type of net credit you can get on this, and then you can adjust that higher or lower again depending upon the yield that you want to get. Okay, so let me break this down for you. This trade was done in 4 days. We always like to do this on a Tuesday and have that expire worthless on Friday, so we get to keep all of the net credit we make. So in this case, the market was bullish. The stock itself was bullish. You could see the trade stock here was around 742, and we entered this trade on Tuesday. And the trade we did was sell the weekly 715.50 put and buy the 712.50 put as a hedge. So our capital required to do this trade, people ask me that all the time. The capital required is different on every trade, and it depends upon what is the difference in strike prices, and that's really it. So in this case, it's 5. So if we were doing 10 contracts, since each option is worth 100 shares of stock, that would be $5,000 for a 10 contract trade. So again, whatever your net credit is when you sell this 715.5 put and buy the lower strike price put, that net credit is what you're going to use to figure out what your return is based upon what you put up. Now these options don't have to be $5 apart. Sometimes it's $2 apart. Sometimes the strike prices are just $1 apart, and I'll show you a case where they were just 50 cents apart. So that determines what your capital required is going to be on every trade, and then your return is what your net credit is divided by what you've had to put up to do that trade. So we're making about 15, 16 cents. Some guys made a little more. That works out to around 3% return on the capital required in just 4 days. So we enter this trade on Tuesday. The option expired worthless on Friday because no one's going to put the stock to you at 715 if it's trading at 761 in the open market. So these don't have any value. They expire worthless. So that's an example of selling weekly options while they have a little time decay and letting them expire worthless. Now, we like to do this every week in a low risk way. Some guys want to make more. You can make more. You would have chosen strike prices closer to the current price of the stock, and your yield is going to go up because your risk is higher the closer you get to the actual price of the stock. I found the sweet spot to be where we stay deep out of the money on stocks that are already going up, and that range is right into that 3 to 4% return rate per week is what we found. Now again, some guys go higher. We have some members that go for 6%, 8%, 10% more per week. All depends upon where you want to use this sliding scale. So in this trade, we sold Google with a put with a strike price of 17.50, and at the same time we bought a Google 712.5 put. And by the way, you can do this all with just a few clicks in an online brokerage account. They have it so that you can do it all with one ticket, so to speak, and you can even enter your and apply your exit strategy at the same time. So we're selling a put and at the same time buying a lower strike price put, and we're doing it all with one limit order. And the limit order we use is the net credit. That's our limit. So during one of the webinars I had, a guy asked, why do we buy this lower strike price put? Why not just sell the put and leave it at that? Why waste money buying that lower strike price put? And that's a good question. And here's why we buy the lower strike price put. Buying the lower strike price put does three important things for us, okay? First thing, it limits our risk because we're only risking what we put, the difference in strike prices, what we put up to do the trade. Whereas a naked put, you have much more risk downside. This also, number two, is important because it gives us a hedge, and that hedge is where we can stay long the long side of this trade if, in the unlikely event, the stock goes against us. And the third thing is buying this lower strike price put helps us. It lowers our capital required to do the trade. And number three here is a huge part of this because in every type of options trade you do, the margin or capital required to do is different. You know, for example, if you sell naked puts, your capital required to do the trade will be much higher than if you did this credit spread where you're buying that lower strike price put. So when your capital required is less, that means your overall yield is going to be higher, you see, because you've got less at risk. So selling naked puts, for example, I get asked about that a lot, and in most cases the capital required is really high. So you have to be able to put up that money to do the trade. And the second thing I don't like about that is if you do get put the stock, even if it's one you wanted to own, you're going to get put it while it's still going down and you're going to lose even more. So this really has much less risk than naked puts. So that's why I like it, and your yields are going to be higher. So the capital required to do your trade is what's used to calculate your profit. So in this case, even though Google was at $7.42 per share, our capital was just $5 times the number of options contracts used. So to figure out the capital required to do the trade, you take the difference in strike prices times the number of options used, and each option is good for 100 shares of stock. So in our case, if you traded one options contract on this trade, the capital required would have been 500. If it was 5 options, it would have been 2,500, and a 10 contract trade, the capital required would have been 5,000. Now the yields are going to be the same because that's the credit on the difference in strike prices. So it just depends upon how much you want to apply to this. And 100 options in this case would be $50,000. So here's why you need to know this, because remember when we sell that put, we buy the lower strike price put and the net credit was 15. And the difference in strike prices was 5 times the number of contracts traded. So the way you break it down is 15 cents. Net profit is 3% of $5, and we make that in 4 days. Now, some people like making 3% per week. We've been doing these VIP picks for 4 years, and we've averaged right around that 3.4% per week average on our picks with a very high success rate. So if you're doing it this way, where I found that sweet spot, you do it over the course of the year, it can really add up and probably give you a higher return than anything else you're doing. But like I say, some people like to make a higher yield every week, and that's okay too. So let me show you some examples with even higher yields. Now, in this case study on Visa, I really love to show people this because it really opens your eyes to how to find these trades yourself. And in this case, the difference in strike prices was just 50 cents. Okay, now on the last one we did, the difference in strike prices was $5 between the put we sold and the lower strike put we bought. So in this case, it's just 50 cents, which is pretty cool because I'm going to show you how just 6 cents can make you rich. Now, this was a trade that even a professional trader made. So we put this out, and people are making this kind of money very quietly with very few other people knowing about it. But I want to bring this up to you because this can really help you. So as I say, the capital required was just 50 cents and the return was 12% for 4 days because the net credit was only 6 cents, but we only had to put up 50 cents to make the trade. So that's how these hedge funds that are just using weekly options are getting these high weekly yields every week. So in this case, they got 12% in 1 week in just 4 days actually. So that was a fantastic trade. And let's look at this in the chart because, as you know, the underlying stock is the key thing to this. It doesn't really matter what strategy you use, if you get the underlying stock picking part right or wrong. If you get it right, you're going to kill it in the market. If you don't, the strategy, you're going to have a problem with that. But let me show you how this one worked out. Again, the underlying stock we used was already in an uptrend. It had a little bit of volatility, but in a directional bias. And those are the key things. So again, we're getting in on Tuesday. We don't like to get in, even though these options are coming out on Friday or Thursday for the following week, now sometimes even longer. We don't like to have this risk over the weekend. Fridays and Mondays are typically the most volatile days, and that we can get some real bad executions on those days. So we like to also go in on Tuesday because that keeps us out of the market about 20% less time in the market over the course of the year, which lowers your risk of being exposed. So that's how we like to do it. Get in on Tuesday, hopefully they expire worthless on Friday, and that's how we do it. But in this case, again, this was pretty cool because the stock is trading here right around $75, and this trade was to sell the 73 strike price weekly put and buy the 72.50 weekly put. Okay, so it's on the same stock for the same week that's going to expire on Friday because these weekly options expire every Friday. And in this case, our return was 12% for 4 days. Kind of crazy that you could even think. It's hard to get 12% per year sometimes. Here's an example where a guy's getting 12% in 4 days. Now, I wanted to show you how this looks on your quotes. This is just a snapshot from Schwab's options table. And so you can see the stock is at 75.09, and what we're doing is selling the 73 put and buying the 72.5 put. And you can see here the difference is 6 cents where this trade went off. This might have gone right off after we put this out. But this is just proof that the last trade here shows a net credit of 6 cents, whether it was ours or somebody else's. But it did go off like that. I just want you to know this is real. Because a lot of times people make up stuff and it just, you can't see how that would play out in the real market. And here's an example of exactly how to do it, how to do it with the proof that it works. So again, the stock was already going up. We get in on Tuesday, selling the 73 put, buying the 72.50 put. Our net credit, in this case being 6 cents, was 12%. Now, you can go again higher up here. If you want to make even more, you can sell a 74 put and buy the 73.50 put, or try to go lower. All depends. If you go lower, you're going to get a lower return, but you're going to have less risk. So that's why I say there's a sliding scale here you can use. It just doesn't have to be just the way we do it. I'm just showing you an example, of how it's done, and you can modify this and customize this to get the results you want. And I'd like to help you get the results you want, which is why I'm making this. So here's another example on McDonald's. This one was 10% return just in 4 days, and you can see this is just another snapshot from the Schwab options tables. You can see McDonald's is $112 a share. We're selling the 110 put and buying the 109 put, and the difference here was just 10 cents. But because the capital required was just $1, that 10 cents on the dollar risk works out to a 10% return. So that's how that works out. Now, people ask me about commissions on this during the webinar. That was a huge question. And really, they're not that big a deal. You can go to optionshouse.com, and they have, usually they have a really good free bonus when you sign up. And we don't get anything from them if you open an account there. I just tell you about this because you can also get a virtual account there, and it really helps you get started. But the commissions are like $4.95 plus 50 cents a contract. So it's about $7.45 if you do 5 options contracts, and it's like $9.95 if you do 10. So it's really not a big deal. So in the chart, I just wanted to show you because, again, we use charts to find these stocks and determine which strike prices to use. So we entered the trade on Tuesday. It expired worthless on Friday. We sold the 110 put. We bought the 109 put. We put up $1 to do that. We netted 10 cents, so that's a 10% in 4 days. So here's the stock price bouncing along, and as long as it doesn't go down to 110, these options are going to expire worthless, and we're going to get to keep all that net credit we made when we initiated this trade. Let's talk about if McDonald's were to start to go down. If it got down to 111, say for example, you can automatically set your orders up to trigger to unwind this, where you'd buy back the 110 put and you'd sell the 109 put. So you can unwind this at any time. But the main thing is you don't want to be in a position where you have to do that. And when you're picking the right stocks and you're staying deep out of the money, that's when you're going to be able to avoid having to unwind that, which is another huge problem. I'm going to address that in the next video I make. I just wanted to give you a quick case study on these.